everyone. Welcome back to another episode of the 6-5 podcast. It's Friday morning. We're back on schedule this week, which is good. You got two from us in 1 week, which is better than last week where you didn't get any, at least not our regular Friday show. But, we're committed. We always figure a way to get it done, and we show up. And on Monday, we were celebrating ourselves, our 200th episode. Well, I got to be honest, Pat, 201, nobody gives a darn. So 201, now we got at least another 49 to go before we can do any hand clapping and back patting for all the success we've had doing this pod. But Pat, it's been a busy week. We are back in earnings season. It's the beginning of earnings season. I saw you on CNBC last night looking super smart, talking about Intel. It's going to be like that for the next couple of weeks. We're going to be busy because there is a lot going on. So, Pat, I want to do the quick disclaimers on this show. But before I do that, how you doing, buddy? How's it going?
And I'm doing great. It's been a kind of an up and down week, and really just unbearing from traveling for 3 weeks. Had to get some real work done, have some corporate meetings, right? But I'm really excited. I'm feeling really good about this week. I'm feeling really good about delivery to the customers, and I just love giving good advice. That is kind of my jam. I don't know where that comes from. I'll let my therapist explain it maybe on another episode. But yeah, I love doing that.
You have a therapist?
Yeah, for the past 15 years, every week. I joke he's my paid friend.
Well,
you're my unpaid friend.
You only have a couple of besties, you got to make that happen, So you might want to call your therapist, tell them that I pulled a real boneheaded move today, locked myself out of my car, and I need to publicly criticize myself. Feeling very human today. So the whole Dan McKenna thing that I've always lived by, thinking I could be a machine. It's amazing how things like this can bring you back to size. I'm feeling very much at size this morning. Having said that, I'll solve that problem later because right now we got a lot to talk about on this podcast. We got 6 important topics today. We're going to talk about Intel, and we're going to talk about Intel, and then we're going to talk about IBM, we're talking about Apple, SAP, ServiceNow. Like I said, it's the beginning of the earnings wave, which means there will be a little bit more of that in the next few pods, but we'll try to make it interesting because we are not financial analysts. Our goal here is not to give financial advice. Our goal is to try to read between the lines, tell you what all of this means, which is tough. Quick disclaimer, the show is for information and entertainment purposes only. While Pat does like giving advice, this is not to be taken as financial advice. Don't do any investing based upon what we say here, but hopefully you will know a little bit more about what we're thinking about these companies and their performance, because that's what we do. So, Pat, we're going to jump off. First topic today is going to be, is it IBM? It's IBM.
You got it.
IBM. So, and I'm going to call your number, buddy.
Yeah. So, net, beat, right? Beat on top line, beat on the bottom for the quarter. But I thought it was, it was also a wrap to 2023. But there were a few highlights that I was impressed with. First of all, the generative AI and Watson X, right? We've seen a doubled quarter on quarter. A third of that business is through software, and 2/3, as you might expect, is consulting, as these enterprises are trying to figure out what is going on, like what should they be doing. And from a revenue comparison, they said, Q3 was low hundreds of millions for Watson X. And, you double that, I guess that's low 200s of millions. I honestly don't know how to do that. Maybe low hundreds of millions. It was 200, which would mean 400 million, but we're going to see. They talked a lot about the demand of the areas that they're targeting for, right? Code modernization, customer service, digital labor, cited 2 banks, Citi and NatWest, plus Lockheed Martin, which I thought was really interesting. Overall, right, that 3.3% that isn't like swinging around the room, super duper growth. So, I like to focus on the businesses that are really, bringing it, like double digits. So generative AI, Watson X. You had some pretty good highlights. I mean, we're on the tail end of IBM Z, and I've got to give Ross Morey and crew a shout out here. 8% growth on the, I think it's the 7th quarter, right, of Z16, and usually that's kind of like a desert, and we're gonna be waiting for a Z16. Consulting, I mean, AWS and Azure, right, up 50% year on year. 40% of consulting business gets back to strategic partnerships. And IBM doesn't talk a lot about the competition, but on the call they went after it and made their case about how they're differentiated. They're the largest consulting group that's a tech company, and I think that's fair, right? I mean, Accenture, is not viewed as an example as a tech company. They're viewed as a consulting firm. So, and software, the highlights for me, Red Hat, 17% bookings increase across RHEL, OpenShift, and Ansible. They gave a 2024 forecast, right? Revenue is in line. Cloak words like $3 billion productivity target. That's likely going to be AI related and people optimization. But man, that cash, $12 billion target. And final comment, highest stock price, I believe, in 10 years, strongest cash generation since 2019. The Arvind Krishna team and the new team is working.
Yeah, it was a really good report. Probably one of the best the company's had in many years. And this is a continuation of the hybrid cloud AI focus. And when you're focused as much as Arvind Krishna is and his team, you get the results. You and I both had a chance to talk to CFO Jim Kavanaugh. Jim also reiterated just the strong operational management, the company's ability to generate cash flow. There were some really great indications about the meaningful impact that AI is having on the business, specifically Watson X. The Watson X business was quoted in the low hundreds of millions. So let's just put the number 2 around that. And then they doubled it between Q3 and Q4. So it went from 2 to 400 roughly. Again, that's me adding an assertion, but low hundreds, 1, 2. If it was 3, it's 6. But the point is that ramp means IBM's on its way to generating $1 billion in revenue from its generative AI technology, Watson X, which was one of the early GA'd enterprise generative tools. So that was really one of the things that stood out to me. You caught on to what's going on with Z. That was very, very good. The hybrid cloud business, I mean, look, it's kind of interesting, but their 22 to 24 guide was all about kind of this low, mid single digits, and that's what they're delivering. It's interesting that that's kind of caught fire, but there's something about stability, consistency, growth, and focus that I think makes investors happy, which is part of the reason it's driving to new highs. But also that margin expansion, that cash flow creation, those are things that people love to see. It sits really well. It shows that things like the Kyndryl spinoff really did make a lot of sense. I'd like to see more acceleration in the Red Hat growth. I think that's a really important part of the business. It's growing a little slower than I would think in the high single digits. I think it should be double digits, if not higher. Well, not higher than double, but higher double digits. And then of course, I'd like to see, and I've been saying this for several quarters in a row, I'd love to see cybersecurity pick up a bit. I think that's a great opportunity for the company across its consulting as well as its technology. And then I do think it's made big bets on observability. That's another area, the Instana, Turbonomic investment. With all this AI, we're going to need to monitor all these systems. You see Cisco making the bet on Splunk. You see companies coming up in this space. Observability is going to be a big one in the future. Yeah. It's not the cool AI, but it's the important AI. And so that is definitely going to be in focus as well. But, really, like I said, you got to kind of look for things not to like in this report. And there wasn't much to not like. Congrats, Arvind, Jim, team. Thanks for the time this past week. And good job to IBM. So, all right, I'm going to call my own number here. Let's go on. We're going to talk about Intel. Intel was an interesting one because, you kind of have kind of a tale of 2 pieces of news, right? The first piece of news is, well, how'd they do this quarter? And this quarter was good. against the expectations they had set. They beat. The problem was, and this is often a problem, is a beat in this quarter is old news, and the guide is always what's sort of set. So if you can't kind of hit on all three, you're never, a beat, miss, may as well be a miss in this era. And that's why Intel saw a 10% drop. Look, I'm going to kind of give it two sides. I mean, there were some things that would have been very indicative that Intel was going to have a harder quarter. And there were some things that needed to, just Mobileye, for instance. You saw that their guide going forward was going to be a huge miss. Now, Mobileye is not a massive part of the business, but Mobileye has been one of the growth vectors of the company over the past several quarters. Pat, the big thing, though, that everybody I think is really questioning right now is all about the data center and AI business. You see the flourishing businesses of NVIDIA, even on the software side, you see Microsoft, you see all the investment in growth, you hear about AWS and Inferentia. The question mark about how Intel, between its CPUs and its GPU, well, not GPU business, and of course its ASIC, Gaudi 2, and it's the oncoming Gaudi 3, and what it's got going on there is, when is that going to start to get momentum and help data centers start to show growth year on year? It was another down quarter. And again, now we're into that period of time where you're down year on year against down quarters. So a couple of years back, it was like, well, they're down, but they were having these remarkable quarters. Now they're down. Now we're supposed to be seeing it pick up. We also know that there's this really important AI PC trend, but that was actually really pretty positive. You saw client computing kind of picked up off the bottom. I think it was 33% up on a year-over-year basis. Pat was, you and I got to talk to Pat Gelsinger. He was pretty realistic about it. He mentioned some of the forces, some of the cyclicality. He mentioned Mobileye. So all these things kind of came at once, and it caused the guide to be a pretty substantial miss. I think it was more than $1 billion off the miss. Having said that, Pat, I'm still pretty positive about what the next 4 quarters. Gelsinger said to us, every quarter and on a year-over-year basis, we will see improvement on the company's earnings. We've seen really good growth in foundry services, 63% up year on year. Not just 63% up, but more winning some really great packaging deals. Starting to get, its process deals underway. I think with Intel 3, starting to go to market with that. Confirm me if I'm wrong on that one. So a lot going on here, Pat, but I'm optimistic. I'm optimistic AI is not over. They have a shot of catching up. I saw you wrote a great paper on their kind of overall AI strategy. Had some good comments on CNBC.
I think you wrote one too.
I did, and that'll come out later. But it's process. It's in the making. It's been a good turn under Gelsinger. It's not going to happen overnight. And I think people think a ship like this can turn in a day. It's not going to turn in a day. It takes some.
So I'm going to spend a little time on the quarter, and then you spent a lot of time on the future. I mean, they beat on revenue and they beat on profits. So they had a beat. Gross margin is the best way, I believe, to measure a chip company, because it gets into its design, your design, and it hits the fabrication, and it hits the pricing, right? And Intel years back was at 70%, and then they went in the 30s. Okay, their gross margins were up 3%. Gross margins up 3% sequentially and 6.5% year on year. That's huge. I think. Also, it hits $3 billion OpEx savings goal. That was a year, obviously not for the quarter. They opened up they've got the first foundry offering, EUV offering in US and Europe, and on track, 5 nodes in 4 years. And the reason why I always get back to the 5 and 4 is because it will determine Intel's cost competitiveness and performance competitiveness. So super interesting. So 2024, I mean, I overall, I mean, I put this quarter, I wouldn't say a mulligan, but when I look at how bad Mobileye, 5G telco biz, and FPGA went, and those were usually things that helped the business, the core business, right, was definitely at the low end of what you would expect for seasonality. I would have expected a little bit more bullishness on Q1 on the PC side. On the data center side, they're challenged. I mean, they've got a ton of homegrown stuff coming after them. You've got AMD that's perpetually strong. And you also have, as Dan, you and I have sat with enterprise OEM #1 people, and they've had a consistent theme of, hey, we've got chassis with CPUs that are waiting for GPUs that we can't ship, right? And there's also been this huge requirement to bring on generative AI in the CSPs. And many of those CSPs have found ways to get NVIDIA and AMD's latest and greatest and just stick them in the same chassis. So there's not a need to ship a new server with an Intel CPU. Now, if AMD comes out and they have an amazing quarter, right, that will tell us a lot. So, I went into earnings looking for gross margin improvement. We saw that. I looked at a lift from Core Ultra, didn't see that. I still stick to my guns that I do believe that industry-wide, we're going to start seeing the real AI, the bigger AI PC action in the middle of the year when Qualcomm comes out. And I believe that there will be operating system support, and then AMD and Intel after that. So I think Q4 is the big lift on PCs. On the server side, Intel has some really interesting stuff coming out. I mean, you've got Intel 3 with Sierra Forest and Granite Rapids. You've got 18A, which is a second half thing for Panther Lake, right? And those are some pretty exciting stuff. 18A is already in the fab, right? Which, yeah, I usually give it a year between that, but it was in the fab in the fourth quarter, and we're going to see servers in the second half, and I'm going to put that at Q4. So, yeah, a lot of interesting stuff going on here. I don't view my long-term prognosis of Intel any different after this quarter than the long term. I'm not an equities analyst. I'm an industry analyst, so I do look at things in a different way. And I want to remind everybody, for all the haters of Intel, Intel still has 80% of the PC market and around 80% of the server market.
Yeah, I feel like I got to say that all the time to people. Like, yes, they've ceded some market share, but they're, people trade them like they're, Blockbuster Video sometimes, or like, like they're Radio Shack. I mean, it's far from that. And they've got an incredible distribution and channel too, which it's not easy to unwind that. It's going to take a lot of work. And, the competitors have made great strides, but Intel's directionally I think it's finding its sea legs. I think it has found its sea legs, Pat. And it's, again, it'll take some years to make up for the years that it wasn't hitting on all cylinders. But I think Pat's got it going in the direction he wanted it going. Big Pat, not little Pat. Little Pat, you're little Pat. So, all right, let's keep talking about Intel, because I mean, why not? Let's talk about some news from this week. Intel made a big announcement with IFS, its foundry business, and UMC on 12 nanometer.
Yeah. So first off, I really appreciate the time that we got with Stu Pan, who runs IFS, to break this deal down for us, answer some questions. And let's go back to when Pat Gelsinger started IDM 2.0. One part of that was, hey, we're going to use external foundries more, right? Read, TSMC, but that they were going to stand up IFS. Because if you remember, when Bob Swan, prior CEO, that there seemed to be some consternation with the leadership team and the board on, hey, should we just punt, get out and become a designer like AMD and NVIDIA? And then Pat came in and doubled down. He tripled down on building a foundry capability. And then we had the failed attempt, thank you, China, of Intel trying to buy Tower, which would mean they would have been full service, which means they could do all the way from bleeding edge to mature nodes and specialty nodes. And then once that Tower thing got kicked back, right, what was Intel's strategy? Like how do they stay full service without, being able to buy a global foundries? And now they're doing partnerships, right? They've got a partnership with Tower. And this was a partnership with EMC. Now, Tower was primarily specialty, right? And, as we've talked about on the show many times, there's the balkanization of foundries, which is we have the West, we have Asia, and then a little bit and then we've got Western Europe, who wants that, and that's based on national security. That's based on getting the right supply chain, and therefore, right, if you're UMC and you don't have fabs in the United States, how do you fulfill those? Let's say U.S. government carrier. I do believe that we are going to see beyond defense balkanization in here in the United States once IFS Columbus and Arizona gets moving, where you have to buy for critical infrastructure. Those chips have to be foundried here in the United States. So Intel had availability in fabs, and they had equipment that's ready, and they jointly went all in on a 12 nanometer to target mobility, think smartphones, and modems, comms infrastructure, think Cisco, and networking. So it's actually a very interesting relationship here. And one of the keys here is, let's look at TSMC as an example. So 50% of TSMC's prior quarter, as we talked about earlier in the week, the revenue is bleeding edge and leading edge. So 3 nanometer and 5 nanometer. The rest is everything below that. And TSMC margins, imagine when all that capital equipment is completely amortized, it's basically printing money. But Intel, that's not necessarily their specialty, but that is UMC's specialty. So I like this arrangement, and I'm really interested to see how much revenue it can drive. I didn't see a lot of details about that. But stay tuned. I mean, listen, time from announcing a deal to getting online takes a long time. The number was floated out there. The year was 2027. So there we go. I said 3 years. Sorry, I just pulled up the press release, and it said 2027. So yeah, 3 years.
Yeah, I think you covered this one pretty good. I mean, look, it's in a market expansion. It's a good use of capacity. It's two companies that can benefit by partnering up. Obviously, it's growth areas. It's growth areas that Intel isn't necessarily fully capitalizing on. And so I look at this one, Pat, as a pretty sound move for the company. Like you said, I think the biggest thing is, while these announcements are great, it's going to be, and it takes a while, and it will be a while before this is before this is really meaningfully accretive to the revenue and to the business. But foundry is the long game for Intel. And so I've been saying for a while, one of the biggest opportunities the company has is in foundry, with geopolitical and national security requirements in focus these past few years. I think the desire to have Intel as kind of the national semiconductor company on the manufacturing side is somewhat visible in terms of policy decision making, and of course investment that's been already committed. So we'll have to see how this plays out, Pat. And we'll have to see how things change over the next few years. But I think it could be a good move. Partnerships like this can definitely work. All right, let's pivot off of semis for a minute. It's good talking about Intel for a while.
Isn't it amazing? Like, Dan, semis, I mean,
eat the
there's
world.
so much interest. I mean, it's just amazing, you know. And again, you know, you and I've joked about this. Like I was so into semis being at AMD for 11 years, and that's where I started to practice. And I was trying to like get away, but you know, half of my revenue is non-infrastructure now, which I'm pretty pleased at. But then it's like you just get sucked into the conversation, and I remember about 10 years ago where even CNBC wasn't going to cover semiconductors, and Reuters actually got rid of their beat reporter for semiconductors. Like, isn't it crazy how times have changed?
Look at what the last couple of years, the supply chain shortage, a couple of massive wars, the advent of AI at scale, and knowing that the next global economic winners will all be built on how semiconductors can power AI technologies. So,
well, look at, and you got AWS, Google, Oracle, Microsoft, all like doing their own chips, and then how Synopsys and Cadence, you know, come in.
You got companies doing $35 billion acquisitions to just be able to design better chips, not even making chips, just designing chips. It's been a wild ride. Many of the biggest M&A deals in the world have all been related to semis. Some of the biggest that didn't happen are related to semis, and some of the biggest that I'm glad didn't happen were related to semis, even though at the time I didn't see quite, you know, remember like the ARM deal, you didn't quite see how big of a deal that actually could have been. Probably best that it ended up going the way it went. So let's talk about SAP then. Let's pivot. You know, they don't make chips, so we can talk about software, right? So actually, I saw Christian Klein. I had a chance to talk to him a little bit when I was in Davos last week. Yeah, it was good to see him. Always good to chat. But you know, this is another company that's in a transformational story. You know, SAP is you know, by far one of the most implemented and deployed software stacks on the planet for companies, ERP, and operationally running their businesses. And of course, they have a lot of diversification in other areas, but best known, of course, for ERP. You know, the company did well. You know, it beat what the street was expecting, and it had a good outlook. And so, you know, it was a mostly positive quarter overall, but the numbers everybody's been watching, the numbers I've been telling people to watch it for the last several quarters have been in the cloud. Is the company growing their cloud revenue? Are they building a cloud backlog? Are they making more profit in the cloud? Are they accelerating their cloud? And then, of course, you know, how are they tying and being able to complement the AI innovation that it's making to winning more customers? You know, the key for SAP is going to be getting their customers to S4, getting their customers running on a clean core so that they can actually build and expand on their business. Now, having said that, probably the most interesting data point of their earnings this quarter was their note that they're going to be making some transitions on personnel. I think there's about 8,000 people affected. I do have to call that out because when I put that out as a tweet and on LinkedIn, I had a lot of people commenting on that. Over the last couple of years, it's been, you know, companies have been looking at technology, looking at how to optimize their businesses. And this is one of those things where behind these conversations, there's always a balance of people and technology. I think 8,000 is not all displaced. It's not all about, I think it's some of them are going to get different roles. They're looking at kind of how to reskill people, how to change roles for people, and some of them be bought out packages. That was very interesting, but not surprising. Having said that, that was a footnote that I think over the next few quarters, you'll see new waves of growth at SAP coming from their AI investments in AI technology. As the company gets their customers over to S4 running on clean core, this is going to be where the opportunity comes for the company to expand. It's going to be where their newest and best AI innovation will be visible, not just Joule, their overall business AI strategy. It's the ability to take data, deliver it to insights, do it very quickly. And of course, the company's also very focused on operationalizing and streamlining workflows. This was something I heard a lot on the earnings call. This is something I've heard a lot through the readout, is that SAP end-to-end is becoming more and more capable. And if you are in on S4, it's more and more capable to deliver what the enterprise and the enterprise of the future needs. So, you know, Pat, you saw 20% revenue growth in cloud, 25% for the year, and 25% for the quarter. So it's accelerating. Saw the backlog grow. from 25 to 25%. You saw the profit grow up 23%. So good numbers overall. The operating profit was down a little bit, something to watch. But like I said, Pat, I think if they can keep accelerating cloud revenue, the company will be in good shape.
Dan, great breakdown. There was so much richness in this. You didn't take all the oxygen out of this room. I mean, on Q4, I mean, if you remember years back, the critics, and I was one of them, that SAP really didn't have a cloud strategy, and here we are for the fourth quarter. They had 20% growth. They have a 25% cloud backlog. They have a growth of 20% in cloud revenue. 55% growth on S4 HANA, right? Largest growth in 5 quarters. So accelerating. SAP got a slower start, but man, are they making up for it right now? And it kind of reminds me of Oracle. And SAP doesn't do IaaS, but they do SaaS and PaaS. I really did appreciate the breakout. And I don't know if this is a new breakout or maybe I just was asleep at the wheel, but I appreciated the 19% growth on SaaS and the 42% growth on PaaS services. 2023 net, Dan, they did what they said they would do, and they're being rewarded for that. So what does 24 and 25 mean, right? So revenue growth is going to come, their plan is to come from Rise with SAP and Grow with SAP, expanding, right, through BTP, Flywheel, cross-selling all of their PaaS, SaaS, and software capabilities, generating revenue through business AI. And they talked a lot about strategic M&A partnerships. Interesting, strategic M&A. We could probably spend an entire session on that. And their plan for profitability, right, is, transformation, which is a combination of kind of rebalancing heads. And, I feel awful for anybody who ever gets laid off, but I have to tell you, I've been laid off at most companies, and it always ended up being a much better opportunities. For the record, it was never for performance. I had a business unit shut down at NCR. Alta Vista offered to move me from sunny Southern California to Palo Alto. I said, I'm going to AMD. But and AMD had 3 months of cash left. They needed to get rid of people like me who weren't an engineer or in sales. But anyways, I digress. Profit also driven by cloud ERP. Interesting. Do you hear that? Oracle NetSuite and Fusion. So and I got to tell you, one thing I really appreciated about what SAP does on its earnings, it seems to be more strategic than, and I don't know if that's because it's a German company and that's what the requirement are, or they just have more wiggle room, where they don't get, whacked by, the German SEC for this, but some really good insights that they brought out.
All right, so here we go, Pat. The DMA. We're going to talk about no earnings. We're going to talk about company that we love to, give a little problems to.
Love to. That's called love, Daniel.
Only because they're so successful. But Apple, a big European moment. Pat, are we going to sideload this app onto our phones or what?
Yeah, so let me do a little bit of background on it. So the EC issued what was called the Digital Markets Act, hence DMA, that they say will ensure fair and open digital markets. And one of the premises of it is that there were these gatekeeper companies, okay? I'll call them monopolists for short. And by the way, it's not against the law to be a monopolist. It's against the law to use monopolistic power to decrease competition. Or, as we've seen, the theory of you could, sometimes 10 years in the future to it. But Who's a gatekeeper? Strong economic position, big impact on internal market, very active in EU companies. That's one. Strong intermediation position, large user base to a large number of businesses. And third, an entrenched and durable position market that's stable over time. Boy, that sounds like Apple and the App Store there. So what this means, and we saw this with Meta, which I don't know, maybe we'll talk about in the next episode. They had to unlink different properties between WhatsApp, Instagram, and Facebook. But essentially, they wanted Apple to be more open market with the App Store, meaning they wanted companies to be able to offer applications that where users didn't have to pay 30%, because Apple has a 100% monopoly position in that right now. The second thing of it was payment, have an alternative payment methodology here. And essentially, and there's a couple more, but essentially what that meant is that Apple, you will be able to sideload applications. You'll have third-party stores. Now, it's interesting. Apple is, you can just read in their press release how angry and bitter they are on this. And they're finding ways that I think some people would say is kind of slimy, right? Which is adding, side loading, like new commissions structures. You've got essentially you have to use a certain scale of bank if you want to put an app store in there. And on one side of it, I can see, okay, that keeps slimy companies from coming in there. But it looks like Apple, instead of kind of opening it up, it actually just put up a smaller wall. And I know here in the United States, they're talking about, even if you make a transaction, Dan, listen to this, on a Safari browser, you will get hit if you're a developer with this. Here's my final comment. People belly aching about any of these changes in the spirit of security, and I don't know, some people like censorship. We wouldn't be here if Apple hadn't been so greedy. Okay, think about it. If you're a developer, not just a developer, 30% to buy the software, but if you're a video streaming company, an app, a music streaming company, I have a subscription for 10 years to an health app. Pay you 30%. What are you, Apple? What were you actually doing for that 30%? Okay, you had some edge networking. You have servers that put, I don't know, 100 megabytes of code that you can download. You have a payment facility that's in there. For some apps, you even have to pay extra if you want to put the data on Apple servers. 30% across tens of billions of dollars in revenue. There's a reason, folks, that Apple never disclosed gross margins for the App Store. And that's because they were huge. And by the way, nothing wrong with making money, but at some point, you have to align value with your pricing. Otherwise, you're going to get into a mess like you got in here. Apple, I hope you learn a lesson here. US regulators, you're wasting time on Amazon buying a vacuum cleaner company. And I know you've opened up, a ton of investigations on this, but you need to bring this to the US, and you need to also stop these smaller walls, like charging, 10% for me buying something if I'm using an Apple browser.
All right, so because I want to move quick because we still got another topic, and I got to call at the top of the hour. Sorry, everybody.
Got 12 minutes, Dan.
Hang on all day. This is a good one though. So first and foremost, I think you covered a lot of the specifics of it, Pat. Here's the reason I don't think it's bigger news is because it's Europe. All right, I'm just gonna pause there. I mean, Europe is the ultimate tax for any technology company. And by the way, when it comes to things like privacy and security, they tend to be more on the right side of what I think and where I think we need to be going. Having said that, they're also notorious for just loving to tax companies for innovation. And so there's always a grain of salt taken when the first fines come down from Europe. I mean, look, Apple plays dirty. It's always played dirty, but it has great technology that people like to use. And for the average user, they don't really care. I don't think most users, I think this is one of those things where you have to separate the consumer harm and the competition harm. From a consumer standpoint, I don't think most users care about having more marketplaces. I just don't. From a innovation and from a competition standpoint, it's problematic. And Apple, like you said, I think you put it really well, Pat, very, very greedy. I think along the way, had they been a little less greedy, and they probably could have kept the monopoly.
I know.
Because they could have said, look, yeah, I get it, but we're only charging 18%, not 30%.
Well, and they threw out some bones to smaller developers, and we now know based on the disclosure between Google and Apple, they cut special deals with some of the bigger companies, but not with others.
Yeah. So, the bottom line is, it's weird because like here in the US, and I know it's a different case, but like the Epic Apple thing fell on its face. I don't think the US, I hear what you're saying, like, let's bring it here. I don't think Lina Khan has the gall to take it on. I think she's batting zero. So she's spending all her time trying to figure out any case she might be able to win, which, now she's shutting down the Roomba. Oh God, I'm going to need I can't get my vacuum from Amazon. But the bottom line, Pat, is what's going on here is really complicated. I mean, you've got multiple ecosystems. If you actually read through this thing, I just feel like this is Apple's just going to find new ways. There's no way they're just going to walk away from all this revenue. They're going to find new ways to pay. You were talking about kind of the smaller walls and the smaller fees. And, it looks like they're just finding new ins to charge rather than this kind of very blunt, big fee that they charge all the developers and all these different transaction costs. They're going to find new ways because there's no way they're going to just let this revenue run away. Having said that, Pat, I think it's a good start. I think it's good to see somebody had the guts to take them on and win. And then the other thing, Pat, is if they don't do enough, there's a lot of risk out there for them. They could have to pay up to like 10% of their annual turnover, potentially, if the EU EC says this is not enough, Pat. But this is good. Here's what I say about this. This story ain't over. This is not over yet. This is going to be a continued story. But until the U.S. actually takes meaningful action, I think it's always going to be a bit of a sideshow in Europe. And so let's see what happens, Pat. But it was a step in the right direction to finally make Apple at least have to, chew its own cud and swallow it. And you could see in that press release, it came back out in a less than a desirable way. All right.
Hey, just to loop back. The EU has 448 million people. US has 300 and change, right? Like, I don't think it's a sideshow. It's a sideshow for B2B, but not a sideshow for B2C.
Okay. So here's where
or maybe I completely misunderstood your point.
No, you're right. What I guess I'm saying is that when Europe comes and slaps a big tech company down with a fine and makes them change something, everyone's like, yeah, that's kind of like they do that like 4 times a year. Yeah. And they make people pay. What I'm saying as a whole, wow, you got some fan.
We have a lot of fans today. We've got, but I don't even know who it is. We must not be connected. But Matt Hamblin, John Hedgewick, and Mohammed is a dedicated watcher. We appreciate you, Mohammed, coming in every single week. Thank you.
You know what, Pat? I'm not downplaying it. I'm just saying Europe. It's like a merry-go-round. Google, Microsoft, Qualcomm. It's just every year it's a merry-go-round of just.
They're very similar to China in that they do a lot of the taxation, but the difference is that China's very open about it, right? We saw the documents on China with Qualcomm, and they're like, you're charging too much. We need to charge this. And Qualcomm did, and everything was fine, right?
Yep, absolutely. So let's wrap this baby up. Let's talk about ServiceNow. Enjoyed the opportunity. Each and every quarter, I get to talk to CEO Bill McDermott on earnings day. This company is just it's a lightning rod. It's just continues to attract business, attract growth. It's got some really exciting key metrics that it was able to hit this quarter. The company saw, I think it was 10 billion of annual RPO backlog. Sorry, 8.6 billion, but almost like 18 of total RPO. It's on a pace to ACV, so your annual contract value of $10 billion. The company's got these amazing new partnerships with Visa and Ernst & Young, basically built on its generative AI platform. So what Bill was able to share with me was that effectively the company's Gen AI has picked up and monetized at a rate that was much, much faster than what was expected. And this has led the company to beating quarter over quarter and year over year. It's going to be a $10 billion annual contract subscription business. It's heading on that pace. He's had really, really bold ambitions for the company's growth, but they're growing on margin. Oh, and by the way, something he said, and he really pointed this out, no layoffs, not ever. Throughout the whole thing, he committed to it, didn't lay off a single person over the last couple of years, hit all the metrics, won the customers. I mean, it's like one of these situations where it's almost hard to not be kind of cheering for it.
No layoffs ever?
No layoffs since, like, he made a commitment in the beginning, kind of when the market turned and all the companies were turning to layoffs. This last, about 2 years ago when the market, in the end of 21, when it started to slow, that he would not lay anybody off. And so the company did not. Actually told me that they had 1 million applications for one position.
What? It must have been an AI programming role for like $1 million or something.
Yeah, he said, that there was like 1 million applications for an open position. I mean, just incredible numbers. I mean, at Futurum, we only get like 100,000 per position that we open up. So he's 10xing me. No, I'm kidding. It was, but like you said, you're seeing 25% growth. You're seeing, the company's focusing on these kind of vertical industry LLMs. So what are they doing with Visa? A transform payment service experience LLM. They're working together. It launched a 5-year strategic. Now, again, this is the biggest payment rails in the planet, Visa. They went with EY, so one of the world's largest consulting company, to build a governance and responsible AI LLM that they can be able to offer AI enhanced, and it's built on ServiceNow Assist. So the platform approach has gone very vertical. They're saying here payments vertical. They're saying governance vertical. They're saying of course workflow, digital experience, employee experience, kind of left to right. And it's like it's an anomaly, Pat. But it's like all they're doing now is they just continually win and surprise, outgrow and outpace. He also, probably one of the most prolific things or prophetic things that he said is that he believes there's a whole new enterprise SaaS platform software that's going to come to market in the coming years. Meaning, basically, the enterprise software as we know it is about to completely be turned on its head. The companies that we know that tend to run the businesses end to end, he believes, could meaningfully change. So, it was a very, very positive quarter, Pat. It was all about Gen AI, though. All about Gen AI, new software workflows, great partnerships, strength in terms of beating the numbers. It was weird because, like, I always try to find at least one thing that's like, ooh, this is kind of the thing I want to put my finger on and turn to poke at a company. There really wasn't anything in this particular quarter that I could poke at. And so that's hard to do. I'm going to keep looking. I'm going to keep digging because I never like to give anyone a free ride. I always like to at least find. I mean, my biggest concern is this. As they keep growing, they're going to start butting up to bigger and bigger companies. And they're going to butt up to new competition that eventually they're going to have to say, we're not as aligned. ServiceNow kind of always aligned to everything, ERPs and CRMs. But now they're doing more. And so that's going to be the thing to look out for, but it would be hard to bet against them being able to grab market share if they can build the software, meet the customers where they are.
A little background on ServiceNow. Their stock's up 68% in the past year. It's on a rocket ship. And I'll tell you, before CEO Bill McDermott came in, it was a company that was just, I don't know, buried, or at least that's the way that I viewed it. I mean, if it's hit an all-time high as well, which is very impressive. And so they're doing something right. And Daniel, one of the things that I always try to figure out, and I just need to do more research on the company, is there superpower technology, or is there superpower sales and marketing? Now, you can have it has to be a good product and has to be delivering. But when I look at if I do a cross section of kind of how they sell and talking to people how they sell, they're a sales and marketing machine. The other thing, if I think they want to go broader, and you talked about this, they don't describe what they do very well, and it seems like kind of a hodgepodge of service management, HR delivery, FSM, I mean, like, what is the binder that pulls it together? And I think getting to that next big shelf, I think they really need to do some work on packaging up the company to be able to describe it to folks. But man, hats off. Their stock's at all-time high.
Workflow it, dude. Let's just workflow it.
Yeah. Bill McDermott coming in, it was interesting when he came in. I was thinking, gosh, you leave. It was SAP before this, right?
Yeah.
Like, why leave that and get on a company that a lot of people don't hear about? Now I get it. Dan, I'm going to give some more cycles to learning more about ServiceNow. For instance, like, which one of my analysts would I put against this? Right? I've got HRM and HCM. Right? I've got a lot of people tools. Like, who would I even put against this? Anyways, that's more of a way to ask a question of what does this company do? I guess I could put 4 or 5 of my analysts against this, and who knows? Maybe you might know some people, Dan, who can make an introduction.
I might, and we may, and there may be something more and something big from ServiceNow coming to 6.5 sometime soon. We'll have to keep our heads down for now, but we'll come back to it. All right, everybody. That's it. That's our show. That's our week. We did it. It's the 6.5. I want to thank everybody so much for tuning in, joining us for this show. Hit that subscribe button. Join us for all of our episodes. We appreciate each and every one of you. But it's time to go. It's time to say goodbye. See you all later.